All right, so welcome everyone. Welcome to this Market Thursday. It's August 26th at 6 p.m. here in London, so almost the end of the summer. But still, as we all going to be back to school soon, I thought it was interesting to talk about the market. Quick disclaimer as always, so those webinars and this one is not investment advice, so this is purely for information. Please do your own research before putting any position. I might have position or might not having position that I'm going to be discussing today, and I do not take responsibility for losses incurred by the viewers today. So quickly, as always, present myself. I've been trading since 2000. I started my career in Paris as a cash equity trader, working for a small asset manager where we were running 50 million euros. Then I moved to London for a bigger team, bigger book, long only and long short, where we were covering Western European, and another team was covering Eastern Europe. Overall, as a team, as a small shop, we were running 3 billion, and we had roughly 750 million at the top for Western Europe. Then in 2008, 2009, I joined Infinity, and just before, just only for 6 months, made off, where from 2008 to 2018, I was doing prop trading, absolute return mandate, no asset returns constraint, across strategies, across region, across asset classes, everything. I stopped at the end of 2017, start of 2018. I was a bit tired after so many years of prop trading. And in 2014, I worked for a company called ITPM, where I was a senior mentor there for 3 years. We split ways, and in 2018, when I was wondering what to do next, some people asked me, what about you do the mentoring? So I restarted the mentoring in 2018, launched a 4x4 video series in 2019, and restarted prop trading in January of this year at Infinity, because I was missing the market, so I wanted to trade again. So I'm doing both mentoring and trading, which I enjoy, and I hope that I can offer both a good service and hopefully having a good P&L in the next few years. So that's the overall idea. So that's for my background. I have a website, duponttrading.com, where you can have information, and obviously you can send me an email if you get questions. So today, what we're going to be covering in the normally, as always, we're going to be doing a situation across asset classes, looking at the 4 asset classes. We're going to be discussing the S&P 500 drawdowns, how the market has been behaving over the last 12 months. And we're going to be talking about the weekly performances around options expiry. This is something that I've been talking many times. I found an interesting tweet last week, so I did a bit of work around it. So this is again something that I've been mentioning for the last couple of years, through the mentoring, through the webinars. So every mentees, we are discussing this. This is something that why we talking about those expiries is because the market, the equity market, is more and more driven by options. So if we don't understand how the option market is changing the market structure, that makes trading stocks a bit hard. I wanted as well to discuss the end of the month and quarter end of the month, and end of the quarter, sorry, how the S&P has been doing. I found some interesting patterns. Maybe that's going to be for the next webinar. So in terms of catalyst, obviously tomorrow we get the Fed with Mr. Powell talking at Jackson Hole. I think it's at 3 o'clock UK time, 10 a.m. New York. So if you go on the Fed website, you're going to find the link. Obviously, there is a lot of expectations, non-expectations about the tapering. Why? Because the US economy has been pretty strong. Having said that, there is a caveat, which is the variant that we discussed a couple of weeks ago, has been slowing a bit the economy, and there are some indicators that are not as strong as they were before. So there is a question mark when we're going to be tapering. Today we had two Fed governors talking about, tapering. As always, the one talking about tapering are the one that are non-voters. So be always careful when there is talk about, who's going to do what with the bad cop and the good cop. So the good cop saying we're going to be tapering, like Bullard and I can't remember, Kaplan was saying they're going to be tapering. Actually, they are non-voting. So it's not that it doesn't matter, but almost. So I just tweeted before about, what the market is pricing in terms of move. I've done, if you look at the YouTube videos, and many of you are watching the videos, not these videos, not live, but after on YouTube, this is very similar to understanding what could be the potential move on the day for a stock if you do the same with the S&P, and if you look at what the market is pricing for tomorrow in terms of odds before the small sell-off, the small 20 points that we had sell-off after what happened in Kabul. Really the market was pricing, looking at the 44.95 Friday straddle, a move of 25 points. Okay, so more or less, if you don't understand what I'm saying, which is a bit, which could be a bit weird, you look at the videos. I think I explained around like 7 minutes what is the option pricing around the earnings. So you could do the same with the S&P for tomorrow. You take the option chain, you take the at the money call, at the money put, you take the two in points, and you compare that with the last, and that's going to give you in terms of odds with distribution, what are the chances of the S&P moving by tomorrow. Okay, so let's jump now. Another catalyst that obviously, so we got the Fed, we got the Jackson Hole. I think the market will be more and more looking at the NFPs. So the week after, we got the NFPs, the non-farm payrolls, which is the unemployment in the US. I think this is key because, again, the Fed is really targeting this unemployment. So that is, if tomorrow the talks are a bit vague, NFPs will be interesting. I just, before the call, look at what happened in 2013. So in 2013, if you remember, we had the same story, which was the tapering of QE2, I think, if I'm right. So the talks, so they announced, the talks started in June 2013 and when announced in December 2013. So very much like 6 months in between, and in between, if you look at what the S&P was doing, over those 6 months, the market went up 15–20%. So what you can do, like I did today, is looking at what the Fed, how the market reacted on the different QE announcements that we had since 2008. So over the last 13 years. So that is not that hard to do. Let's go into how the market has been performing. So if you've been watching those webinars, this is something that I like to be discussing always, which is on the left-hand side in blue, how the equity market have been doing across the world. So again, the developed market, Western Europe and as well the US have been doing very well. So we are up between 15 and 20% roughly. Only the FTSE is a bit lagging, but overall we got a big gap between emerging market, which are struggling. So as you can see here, emerging market is down as of yesterday. The only one that is doing fine, it's the Indian market. So we got emerging market, China/Asia, which has been struggling. There has been an acceleration in the sell-off the first few weeks of August. We had a bounce on Tuesday. on many Chinese names, from Alibaba to Tencent, so they bounce by 10, 15%. I know that some of you get exposure. Be careful on when you go for US ADR, because literally you are buying some, you're not buying any real, you don't have the property. So you're better off, going for Hong Kong best, but again, be careful on all those names. So equity market, the trend, there has been a risk on, as you know, since the start of the year. In terms of currency, so this is this part, the dollar has been strengthening. I've been saying it over and over. I'm not surprised by the dollar strengthening. This is something that I've been saying since January, when everyone was saying, the dollar is going to be rubbish this year. I don't think it's going to happen overnight. Bitcoin up 70%. I know that some of you on YouTube will be smiling, and that's the crypto. So the crypto space rebounded quite heavily over the last month. And the gold struggling, and WTI, which has been pretty much rebounding 10% from the lows that we saw on Monday. So let's go into the next slide up. And this slide, so we had a risk on over the last 5 days, which we're going to discuss later, because last Friday we got the option expiry. So there is always a bit of volatility around the option expiry. BTC, Bitcoin moving up nicely, 10%. Next slide. The sectors, as always, year to date, any sector is up, but now we get the financials taking the lead. Interestingly, over the last week or so, financials have been pretty strong. JP Morgan was up 1.5% at the start of this session. Then it came down a bit, but Wells Fargo, Bank of America, Goldman Sachs, all the names have been very, very strong. Yields are going up, so that is helping the sector. And I think as the share buyback programs are really kicking in now, since July, that is helping the overall sector. So this is, again, 11 sectors of the S&P. If you are struggling for ID generation, so I had a call yesterday, a mentoring call, where rightly so, my mentee was a bit struggling. I think one of the ways to generate IDs is to look at the price action. What is the price action? What has been outperforming? What has been struggling? And always do that versus the S&P, for instance, which will be your benchmark, or you can do the same with the QQQ, and trying to see how those different sectors, how those different industries have been doing versus those benchmark. And you can do that over 5 days, 1 month, 3 months, year to date. You decide what is your time horizon, and that's, at least that helps me a lot to generate ideas and to see what is strong and what is weak in the market. Next slide, asset class performances. So here we're talking about the bond market. So pretty interesting. The yields have been going up, meaning bonds have been selling off a bit. We're going to be looking at the chart of the 10 years in Italy, which is called the BTP. And in terms of yields, we had quite a big move over the last 5 days. I'm not exactly sure what it is. I'm not smart enough. I think there is obviously a lot of supply coming in September, a lot of bonds that will be coming into the market. So investors are kind of front running and asking for higher yields. And with the Fed expectations as well, it kind of makes sense that for the yields go a bit higher. But I don't have that much more of an explanation. The VIX back to, so that was as of yesterday, so now it's a bit higher, but between 16 and 18%, still pretty high if you think about that, the market is at all-time high and we only 50 bips or 30 bips or 40 bips from the all-time high. People are buying a lot of downside protection, and as well there is a lot of upside calls on single names. So implied vol is pretty high. That doesn't mean it's not going to go higher. But again, as I told you before, if you are looking for downside protection, make sure that the VIX comes down a bit instead of buying the VIX into the 20s. Top winners, top losers, as we can see here, Chinese names that are bouncing, and a lot of dodgy names, the GME of this world. So if you're long GME, and probably you've been doing very well, but GME, AMC, those memes stocks, retail have been performing pretty well. Retail names, not necessarily retail sector. So those has been the moves that we've seen recently. What about we go into the technical analysis, and then we're going to go into the macro chart. Let's go into trading view. So let's start with the S&P. So this is the chart of the S&P. As long as we are trading nicely and we are not breaking this both the support and the 50 days moving average, which is really the magnet, the market is going up. We're going to see that there is seasonality in the market. And, you know, don't make fun of seasonality. Why? Because very often the month of September is a weak month. And it feels like the market could squeeze a bit, then, you know, we might have to reset. So this is for the S&P. Let's do quickly the Nasdaq Composite. So Nasdaq Composite making new highs almost. Actually, it has been doing better than before. It's still lagging the S&P on the year to date, but we get some names that are trending pretty nicely. The Russell that we discussed from session to session, it's still doing a base since March 2021, and the trading range is between 2130 and 2360. Okay, so that gives you 230 points. So something like 11%. The trend, the very strong trend that started from the election last year is now breaking. So really we are consolidating. So a lot of noise, many names moving, but that is the base for the Russell stock 600, because we can be talking about European stocks as well. Trend is still there. We are still in this channel that we initiated since the election, and it's going up. There is a bit of consolidation, but the trend is still there. XLF, as I just mentioned before, the banks, as you can see, we are trying to be making new highs after new highs. So sector has been very strong. Yields going up, as I said, share buyback. So that is leading and giving some strength to the sector. XLB, the materials. So the materials were very strong all year. Then we have been consolidating since then. I think since June, as the stimulus, the stimulus from the Biden administration is taking time to be voted, and you know, everything feels like all those materials were on the tier. Now it's consolidation, consolidation time. Again, do a bit of price action on those 11 sectors. That's going to probably generate some ideas. Strong stock, Microsoft. I think this is an interesting one. Let's go into a regular chart. So that's a bit of a dodgy technical analysis, because when you get 2 points and you try to find the resistance, but that has been really a very strong name. Software names have been extremely strong. So as always, if you are looking for a continuation of the market or turnaround in the market, look at the leaders. If those leaders turn, that could impact the overall market, obviously. What I find interesting is so far the market was going up without financials. Now financials are starting to move higher. So that could be the next leg up. NVIDIA, I mean, just wanted for the chart, because the chart is just, you know, it's just insane. Let me put you the chart in long run. NVIDIA on the tier, if you do the Philadelphia Stocks Index, this is the same. A bit of BABA, a bit of Chinese names. So the trend is still down. We bounce nicely around this 152, 155, but the trend is still pretty much down. So you still get this downtrend. Nothing has been really changing. On the other hand, we get significant volumes since Friday, but you know, as long as you don't break this, the picture is the same. Alphabet, Google, this is the chart that I have. So this is the trend that started in October 2020. The trend is your friend. You know, if you can find those trends, and obviously if you've been in there, you're making a ton. But this is really, those market leaders are doing fine. Italy 10 years that I just mentioned before, moves in the BTPs. I'm not sure exactly. I talked to several traders yesterday and some of my friends and colleagues. We had a move in the BTPs from 55 bips to 65 bips, so a move of 10 bips for no real reason. I think, yes, again, there is a lot of supply coming, so that could impact. But I will keep on monitoring these moves on the bonds. US 10 years, is it going to be different? Yeah, 135. I don't know what to think here again, so I'm not going to be talking too much because I'm going to be useless. Euro dollar. If you've been following my webinars, you know that I have a tendency to think that it's going to go to 113. This is the big magnet here. I look at the Aussie dollar up quickly. Aussie dollar, it feels to me like, you know, the 70 are in place. So that's not much for me. That's 3 to 4%. But as long as China is a bit struggling, that the whole region is struggling, this is really since the peak that we had. Again, if you remember, start of the was bullish on emerging Asia, everything, and since then it has been coming quite nicely. So 70 is in play. And finally, I want to be talking about copper, my friend, the copper. So here, copper, I'm going to be doing a logarithmic chart. Same, it is consolidating since the big move. So many. I'm not going to do 20 of them, but you get the idea. There is a lot of consolidation for names, and you get the market in the meantime that is going higher on very few names, 10 to 20% or 30% of the names, which are driving those moves up. Let's go back into the macro chart. As always, I want to do a bit of macro after the price action. So the macro, those charts are coming from Barclays, and I think this is interesting, which is the correlation between the PMIs, the purchasing. Well, I'm struggling today. So the PMI and the equity flows. And as you can see here, there is a strong correlation, and it tends to follow economic cycle. So if you think that that we could have reached peak seasonality or peak cycle in those earnings early already, or in the PMIs, then the flows could come down. So those are the equity flows. And next one, this is from the Citi Economic Surprises Index Global. As you can see here, so if you take this as the average, we're coming back after a very strong recovery based on the world reopening and central banks. Now we are back to square one, which not only puts the idea that earnings might have peaked, but as well, if you think that earnings might have peaked, that equity flows might have peaked, means that the equity market could be close to peaking soon. That is the same here. Equity flows also follows earnings revisions, and this is the same with EPS. So interesting charts where you can see that the equity flows here in dark blue are following the revision of EPS from the MSCI. So again, there is a strong correlation between earnings growth and the equity market. When there is earnings growth, normally equity market should be doing well. First subject after this price action and macro chart, I want to discuss a bit the S&P drawdowns. So S&P drawdown, I want to discuss in terms of risk management and understanding the cycle. So this is the picture since 2000. And actually, this is when I started to work, but not only. And you can see the drawdown in the magnitude of the drawdown of the S&P. So in around 2003, 2004, the dot-com bubble exploding. So the market went down by 45%. In 2009, 2008, 2010, we went down by more than 50% from the all-time high on the S&P during the great financial crisis. And in 2020, last year, we didn't even go by more than 30%. So what is interesting here is you can see that the strength, the weakness was like half of what it was over the other two cycles, and it was much shorter in terms of time. What it does tell you is, and I haven't put the chart, normally I will put the chart, but the central banks are bigger and bigger and are quicker and quicker to intervene. So if you look at the size of the increase of the balance sheet of all the US, Europe, and Japan during the crisis that we had over the last 18 months, those balance sheet increased massively. As always, you know, there is a question mark now of how much can you increase and what could be the cost of opportunity of doing more. But literally, in terms of S&P drawdowns, you can see the difference between 2009 and 2020. If we look at the next slide, at the S&P 500 drawdowns over the last 12 months, so since August 2020, as I mentioned before, September, October, we had a sell-off, okay, between 8 to 10%. So there is a seasonality that over the last 20 years showed that September is very often a weak month. As always, you know, it's not because it happened in the past that it's going to be happening again, but those are the odds. But over the last 12 months, we only got 12 months ago this 10% move down, and otherwise for the year, the worst drawdown was 4%. So over the last 9 months, we only got 4% drawdown, and the drawdown are smaller and smaller. Again, feels very much like if you try to put everything under shelter and you try to mitigate or to slow everything as much as, when I say to slow, is to dampen, should I say, the volatility. When the beast is going to wake up, it could be quite something. So these days, again, 2 to 3% correction drawdown, that is the max that we are having. If the economy is slowing, as some leading indicators are starting to, not slowing, but peaking, then we might have a correction. This is a slide that I used, I think, a couple of months ago, which gives you the seasonality for all the months. So this is for September. We're starting from next week. This is for the S&P, the NASDAQ, and the Stock 600. As you can see, on average, since 2000, this is the worst month. That is the odds of what has been happening. So be careful. The market is at all-time high. There is no correction. There is everything is like ooh, aha. There are some red flags now that are telling us, you know, something might be coming. Option expiry, again, for those of you who know about it, I'm sorry, but that is something that I've been talking over the months. So option expiry, or OpEx, is the week before the options expire. So for the S&P 500, there are weekly and monthly expiries. Weekly will be on Monday, Wednesday, and Fridays. And the monthly will happen on the third Friday of each month. And that will be the biggest expiry of the month. And then we have the quarterly expiries, which are on the third Friday of the months of March, June, September, and December. So just to get this, you say 3, 6, 9, 12. 3 for March, 6 for June, 9 for September, 12 for December. And those expiry, the quarterly expiry, used to be the biggest of them all. But since 2016, the CBOE introduced those weekly options, meaning people are more and more trading short-term, trading those weekly options. All those AMC, GME, all those meme stocks, or even NVIDIA, Apple, are driven by very short-dated options. So the impact of those quarterly expiries are not as big as they used to be. And we are more and more looking at those monthly expiry. So what is the OpEx week? The OpEx week is the option expiry week, which is the week going into the third Friday. Why? So here, this is something I mentioned again. If you go on the CBOE website, you're going to have this calendar. So if you look at the month of August, you know, on the 20th, which was last Friday, that is the standard expiration. This is the biggest one, and that's the September. For the next one, then you're going to have in gray all the weekly one. So look at this, have a look at this calendar, put there somewhere on your schedule, and as well do the same for the VIX expiries, because the market is very much driven with the VIX futures. So why I want to discuss about is because option expiry, when we buy or we sell an option, the market makers will be taking the opposite position. Okay, so hence those market makers will be carrying risks, and they'll be carrying risk in terms of Greeks. So I'm not going to go into those options and explaining the Greeks. If you want to do that, you should subscribe to the 4x4 or do a bit of Wikipedia. But when the underlying, which will be the S&P, or if that's for another option, the other underlying, the market makers will have to adjust their risk parameters in terms of delta, in terms of gamma, and they will be doing so within their limits. Okay, so they will have like weekly limits, monthly limits, quarterly limits. And as options have been exploding on the way up, and it's even more true, as I said, since 2016, market is more and more driven by those options. And they will be more and more driven by those weekly options and those monthly options. So you're going to have cases where, and that is a bit more advanced, but looking at the gamma, where the market will be looking at what we say the market could be pinned to a level where there is tons of exposure. So for instance, last week, there was a lot of exposure at 4,400, 4,450, or the market could get squeezed into the expiration. So that's something that happened in 2014, 2015, or market could reverse after the expiry. If you think about what is happening is market makers have a book of options that they have taken against their clients. And on the day of the expiry, obviously, all their exposure is going away. So that means if you have, as a market maker, tons of exposure, let's say for tomorrow's Friday, on Monday, normally you restart your exposure. So that means market participants normally are keen on putting new exposure start after the expiry. So what has been happening recently, and here, just to give credit where credit is due, so pour rendre à César ce qui est à César, there was a very good tweet from Patency on Twitter. I don't know him, but I think this is very interesting, trying to explain what has been happening recently around the weekly OpEx, the monthly OpEx, and trying to see if there has been, as always, a pattern around those expiries before or after this expiry. So to give you a clue, what we will be looking at is this one and this one. So on the OpEx weeks and 2 weeks before the OpEx weeks. So let me go through this idea. So here, those after looking at this this tweet, I've been working for a few hours on trying to confirm what was the conclusion. So around the OpEx weeks return, we're gonna have returns on average at 0.15, median at 0.35. The worst is minus 15%, 7%. So you can see it's quite volatile. So there is not much of a trend so far. If we look at the worst option, which was in March last year, so that was literally when the market, so here this is the week of the expiry, and then we turn. So very often what you see is when there is a sell-off in the market, when the gamma of the market is extremely extended, meaning it resets after the Friday and the Monday, and those are the times where there is a good chance that the market could reverse because of let's say, absolute position. That was exactly the same that happened in December 2018. I don't know if you remember, around Christmas. So the market sold off, and then we had the bonds. So on the OpEx, on the week of the expiry, the market went down 7%, and we had a reversal. So when the market goes up very much or goes down very much, very often this is the time for potential reversal. And that happens very often after the expiry. So here we are looking at the option expiration returns since 2004. So as you can see, I've been doing a bit of work. So as we saw before, when there is a big sell-off, that could be a catalyst for market turns. And that is even more true when there is a quarterly expiry. So if you look at March 2020 or December 2018, those were even bigger expiry because we were talking about December and March. If you look at between 2012, so roughly between here and 2015, you can see that the returns for expiry very often were positive. So what was happening is the market was slowly grinding into the expiry. So market was long gamma, and every day we were going up and up and up and up. So what has been happening recently? What has been happening recently? So this is the pattern since the start of 2020. And those are the returns, the weekly returns on OpEx weeks. And as you can see, there is a clear pattern that the numbers are very negative, at least in 2021. That is negative, 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 that is negative. So instead of having positive returns on average, we really have negative returns going into OpEx. So OpEx returns in 2021 have been pretty bad. So there is a joke in the market that everyone is front-running now the OpEx expiry and the OpEx and are front-running the market makers and taking the position before. And if you look at what happened this week, last week, this is exactly what has been happening. So there was another tweet on explaining how it has been doing. So here I put all the recent expiry in yellow, and I put the S&P chart, trying to see if and how the market has been behaving around the expiry. So 19th of August, the most recent one, you can see market is moving. 16 June, here, same. sorry, that was July, June, same. Here a bit before, moving. So here, moving, here, nothing. So very often around those expiries, what happened before? So now it's more, it used to be after the expiry, and now it's before the expiry. So there is a front running of the market makers. But really, and if you look at the VIX as well, obviously this is the correlation between the S&P coming down and the VIX going up. So here, expiry, boom, expiry, boom, expiry, boom, up and down. Just before expiry, boom. So it's not like, you know, people are saying, you know, around the 15th of August or the 15th of July, I'm going to do something because it's mid-month. It's really because of those options expiry. So be careful as well as something that I mentioned before, that if you are mostly trading options and if you are looking at downside protection or downside direction, don't be the person who is always buying implied vol or premium when the market is topping in terms of implied vol, because you're going to be overpaying implied volatility around that period. So the weekly returns now, so that comes from the tweet, and again I've been doing with working with Bloomberg on those numbers. So OpEx weeks, as we discussed, pretty weak going into the week, OpEx week for over the last 12 months. As always, when everyone on Twitter and in the world start to know these things, probably in September is going to be the other way around. But what is significantly interesting in terms of data, and this is 2 weeks before the OpEx, really the market, the S&P have been very strong. Okay, we are talking up since for the last 12 months and nicely up sometime. So the pattern that we have been experiencing over this OpEx period is on the week of the OpEx, which was last week, and this is why we had partially and not partially the S&P move from the Monday to the Friday. And then if you think that 2 weeks going into the into the OpEx, you can have a nice market. I got the feeling that for this expiry is going to be, it's going to be the opposite, because it feels very much like the market is overstretched now. As I said, I think technically there's 1% to 2% upside. But I thought it was interesting to discuss those odds, to discuss as well how the market has been behaving around the OpEx. Quickly, about where I can help you on top of these webinars and tweets and everything. The trading community, so now we get more than 70 traders active, a bit less during summer, but you know, I think people will get more active from September onwards. So trading community where we share ideas. The idea really, it's about, you know, general discussion, macro, long ideas, short ideas, the risk management, building your infrastructure. So that is very similar to the 4x4 video series, something that I built in 2019 based on my experience as a mentor and doing 20 years of portfolio management and prop trading. So if you have questions, you send me an email. And finally, the mentoring, which is for more advanced traders, typically for people who have done the 4x4 video series. We do 12 sessions on Zoom or Skype, and we work together on building your infrastructure, doing the quantitative analysis, qualitative analysis, price action, risk management, blah, 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 and blah, blah, blah. Works well. If you are interested, going forward for the next 3 months, be quick, because new people are coming. I've been few places from Asia are now locked. So literally, if you are interested, you should hurry a bit. If you got questions or if you want to have information, you go on duponttrading.com. You can send me an email. If you like what you've seen today, and if you're on YouTube, please comment or like, forward, tell your friends. Maybe a few questions. Andrew talking about the COT reports and pro traders are going to cash. That's funny what you're saying, because over the last 3 months, if I look at the exposure in the prop trading, that has been massively reduced. Having said that, if you look at the big numbers, I think the cash is at a very low level, 1.5 to 2% overall for the market. And actually what's interesting is because everyone has been struggling with the short, there is very few short in the market. So the market has been squeezing nicely. Any other one? So if you got questions, send me an email. Tomorrow we got the Powell talking, 3 o'clock UK time, 10 o'clock New York time. We'll see what can. Price action so far has been pretty strong. Feels like it could be squeezing a bit more, but then, you know, I think September is going to be interesting. Very low volume, very low participation. I hope you had a good summer. Summer is not over, but and I'll be traveling a bit this weekend as well. So talk to you in 2 weeks, and I hope you enjoyed today. Thank you, everyone. Bye-bye.